Hi, I'm Dave Brickell, Director of Sales at Paradigm. Welcome to The Big Picture.
Vol is reverting. So the obvious trade is always the expensive one to
this
carry.
whole peak inflation, peak rates narrative, peak Fed, which we've been talking about.
It's an expensive place to find out. Crypto vol, a potentially fatal place to find out.
The crypto option markets are definitely showing some signs of life. Hi guys, welcome to The Big Picture. My name is Joe Cruy. I'm at Paradigm in the weeds around everything crypto vol markets. Joined here today by my colleague David, quite a regular on the pod now these days over in London, as well as Sohan Sen in Asia, who's becoming more and more of a regular. Today on the podcast, we have Adam and Nathan from 2 Prime. Welcome, guys. Just to start, would love for you guys to just give a quick introduction for our viewers on your backgrounds and what you're doing over at 2 Prime.
I'll go ahead and just intro myself. My name is Nate Cox. I'm the Chief Investment Officer at 2 Prime. I've got a history in the traditional finance markets, like a lot of fund managers, I think. Focused on derivative side. Previously was the CIO at another fund that focused on volatility and equity derivatives and index options trades, and brought a lot of that into the crypto space in 2020, which is when I joined 2 Prime. And we kind of focus on a lot of the quantitative side of derivatives and vol trading in the crypto space.
Very cool.
And I'm Adam. Thank you. Yeah, Adam Richard, Director of Capital Formation at 2 Prime. Been in the crypto space for quite a few years and have done a lot of different entrepreneurial things in the ecosystem. Worked at an investment bank and broker dealer prior to joining 2 Prime in 2022, and worked on cap raises for some L1 protocols and worked on a lot of different infrastructure for digital assets and within the ecosystem and helping them get institutional adoption. So joined the team a year ago and mainly focused on making sure that our clients are getting good service and make sure that we're all heading in the right direction.
Awesome. Well, welcome guys. Really, really appreciate having you guys on. So I guess we can just jump right into it. Let me just share my screen quickly. So a bit selfishly, an area that I'm super interested in, yet you can't find a ton of information on, is crypto derivative usage for Bitcoin miners. And anecdotally, this is kind of actually how I discovered crypto derivatives even existed. Going back a few years ago, I've been doing some research on crypto mining firms and naturally thought, similar to a commodities company that is, say, selling forwards to lock in delivery rates, I imagined that some of these Bitcoin mining firms could be using derivatives to lock in output prices through trading of futures, or perhaps they're doing collar strategies, overwrites, etc. And through that research, and that's how I even figured out Deribit existed. But then I attended Bitcoin Miami last year, and I actually had the chance to speak with some miners. And mind you, that a lot has kind of changed in the past year. But a few of these conversations that I had, I asked them, like, how are you guys using crypto derivatives? Like, how are you guys hedging your exposure or even looking to yield? And they kind of looked at me, a lot of them, like I had two heads. They're like, what do you mean? We don't do that stuff. Bitcoin only goes up. And it kind, in a way, it kind of felt like a company like Glencore not having a trading desk. It was just like completely insane to me. And we've all seen the news of miners struggling or even closing down operations. And I'm just really curious to hear like how your conversations with mining entities has evolved, like especially over the past year or so with, the lower price of block rewards, higher electricity costs, and higher hash rate. How are these guys thinking about it?
Yeah, this is a great question. I'll give my 2 cents and I'll let Adam chime in as well, because I know we talk about this a lot with clients, but it's been super interesting, right? So I totally agree, and we've written some papers about this. But the mining industry in crypto has come a long way, especially in the last year, in terms of maturity towards using financial instruments and structured products to start to hedge exposure. I think if you asked anybody before 2021, the strategy was basically this retail hodl strategy, because everybody just thought Bitcoin only goes up and to the right. And, the sort of institutionalization of mining and the industry as a whole has matured extremely quickly. But they really are playing catch up when it comes to hedging any kind of exposure they have, because they had this let's just mine everything we can. We'll hold all of the Bitcoin. We won't sell any of it, and we're going to make millions or billions of dollars. And that was a great strategy until 2022. And all of a sudden you had some of the largest miners in the space, Core Scientific, these other, major players going bankrupt. And it turns out that they had to do some growing up, and derivatives are the way to do that, obviously. Adam, you could probably speak to some of the hash rate index derivative products that people like Luxor have come out with. But it's, we're trying to have this conversation more with miners specifically because they've had sort of this come to Jesus moment last year. And when you look at things like hash rate and Hashprice, it's sort of been forced upon them. But I'm glad to see it happening because, again, all of these things sort of push the industry to become more stable and more dependable. We don't want to see these miners going out of business because they forgot that you should hedge exposure. So that's sort of the high level view that we've taken. Adam, you might have some more about the hash rate index stuff, I'm sure.
Yeah, and I'll also say that, when we first started talking to miners, as Nate mentioned, what we found was that a lot of them weren't really looking into it. They weren't prepared to do it. They didn't understand how to go about it. What we also found was that the Bitcoin miners that did have more of a kind of institutional finance background were more educated and were actively doing something. It might not be as sophisticated of a strategy that 2Prime might deploy for them, but it was good to see that you do have people in this industry that do have some knowledge and experience, but they're very, very limited. So I think there's a lot of Bitcoin miners out there that need this assistance or can take advantage of the expertise that companies like ours can bring. And the other thing too is that we saw that everyone is really unique. No two miners have the same situation. They all have different amounts of debt. They all have different situations where they may want to put Bitcoin that they're holding to work. They may have a sell strategy, and so they're selling the Bitcoin that they're mining. And so these two types of miners and the variations upon each one of those all have different ideal goals that they're trying to achieve. And so what we can do as a manager is build a strategy for each one of them. But then it's also great to see, as Nate mentioned, that companies like Luxor are launching their hash rate derivative product, which is a long hedge on the price of mining. And so you're actually able to hedge the hash rate itself and the hash price itself, I should say. And so this is a product that I think works for a lot of miners because it really kind of distills down the most important financial component of their business. And so to have a product out there that's getting to market, getting adoption, is growing, is great. And I think more and more can leverage that. But at the same time, everyone is different. And so they do need bespoke solutions that are created for them as well.
Right. Yeah, that makes sense because, effectively for a miner to sleep well at night, right, you need to be able to hedge the BTC price. Power markets are robust, so you can hedge your electricity costs. But the big one is hash rate, and as you mentioned, this is something Luxor is doing. And from what I understand about it, it's effectively just a cash settled contract for difference around this asset that they call hash price, and they define hash price, I believe, as the amount a miner can expect to earn for a specific quantity of hash rate. So sellers can lock in their rates and therefore their Bitcoin mining revenue, while a buyer can speculate on. But to play devil's advocate on it, and I come from an equity derivatives background, for the ability for markets to build, you need the ability to replicate the derivative. If I'm a market maker that's facilitating a hash rate derivative transaction, how do I hedge this? Especially because the correlation between spot prices and hash rate has broken down. If I can't hedge this as a market maker, how do I provide liquidity in this market? Do you guys have any thoughts around that?
my initial thought is, yeah, this is the problem with hash rate derivative markets right now and we've had this conversation with some of the participants, because while there may be, the market's essentially really one-sided, right? Market makers don't necessarily want to take the other side of this trade because there's no way for them to lay off the risk. And so it becomes this like chicken and the egg sort of dilemma where miners are more than willing to sell the option to hedge out some of their hash price, but there's nowhere for the rest of that market to say trade and sort of and really, I guess there's not a lot of interest in sort of speculating on the long side, because if you're long hash price, you're basically you are a miner. So it's an interesting paradox right now, and we watch this too. And I'll say I think the market's still pretty nascent. I mean, I'm looking. I think they launched this relatively beginning of this year, so I think there's a lot of room for this thing to grow and start to get some traction. But yeah, I certainly don't purport to have any kind of solution to this right now. I think there's still an early market. I think the reality is that the majority of miners, and we talked to a good amount of them, are still playing in the BTC derivative market because it's the most robust in terms of how they can provide or sort of utilize these liquid hedging instruments. What I will say, and this is sort of moving back into the BTC derivative side, is that what we see is there's more sophistication now around how miners can hedge. So I think the most common thing that everybody knows about is sort of simple call overwrite strategies that everybody was using. But now, as we talk to miners, we're seeing them start to explore things like synthetic long delta plays, where they're selling spot to buy either a perp or buy like a call option or some sort of convexity, where they can guarantee cash flow for the business but still operate with some sort of long bias in the market. So those are the types of things that and then you have structures like put collars and these things, where this is what's interesting to us, is just see that the market is getting more sophisticated. I'm sure the hash price index will get legs over time, but it's it's like we're watching teenagers grow up right now and they're going, oh yeah, there's a bunch of things here we need to start to figure out.
Yeah, but that being said, and that you guys really touch on this in your report, is it kind of feels like the crypto derivative markets right now has strong parallels to the oil and gas markets in like the early to mid 70s, before they really took off, right? This market needs to figure out.
Yeah.
I mean, I think we're confident there's certainly a need, and 2022 shows that people kind of need to get their shit together. If this is going to be, you're going to have a long-term sustained business model.
Right. Yeah.
Yeah. I mean, I have a question for Nate, actually. So you mentioned a few different strategies that miners use, right? I mean, could you go into a little bit more detail about each of those? Like, how exactly it would work with the call override and the collar and things like that?
Sure. I mean, these are, I would say, pretty standard sort of hedging structures from like an oil and gas trading desk, right? These are call overrights, basically a way for them to lock in some sort of yield on their BTC, which is the only way for them to really generate this. I would say that's more of a treasury management sort of strategy. What we are starting to see is more of a cash flow management, like they need to cover OpEx, so they need to sell monthly production, right, to guarantee cash flow into the business. And this is since 2022. Nobody cared about this shit until 2022. All of a sudden, when they're looking at basically break even, they had to come up with a way to get cash in the door. And so Adam and I were talking about this earlier, but Bitcoin is unique in that there's still a very speculative angle where, oil and gas prices just generally are probably limited to a range or a vol that keeps them between $10 and $100 a barrel, let's just say.
Right.
But Bitcoin is, people are still speculating that it can go to, pick a price, right? 50, 100, 500, a million. And so miners are uniquely sort of, they're put in this position where they have to decide do I want to hold? Do I want to sell? Do I want to speculate long? Whereas oil and gas, the ability for them to expand was basically lock in capital, reinvest it in their production cost. So yeah, I mean, I think the structures that we're seeing now is like sell the monthly production, buy calls, or hold the monthly production, hedge it out long put, things like put collars where they're selling calls to finance. We like to offer more bespoke things where if you look at like a call overwrite strategy over a long period of time on Bitcoin, tends to be negative in terms of the net return. So it's not super attractive. But if you add a simple thing like selling positive skew, the returns go way up if you're just sensitive to when you're actually selling overpriced calls, right? So these are the types of things. It's a harder conversation to have because it's say a burgeoning industry or sort of it's a new language for miners. But
right.
If we can start to add a little bit of sophistication into how miners think about hedging, that's what we're trying to bring to the table.
Right. That makes sense. So I'm curious to hear, so when you're doing your portfolio construction, like what would you say the allocation mix generally of that is? Would you say investors are still much more interested in kind of overwriting selling calls, or now you actually seeing these guys buy puts? Because some of the conversations that I've had with the big OTC desks is these guys don't want to buy puts.
Yeah, this changes miner to miner and day to day. I think at the end of 2022, everybody was like, we've got to hedge this downside. We've got to lock in price. So they wanted to sell spot, and maybe do some sort of like long call structure. I mean, Adam, you were talking to, I think, 2 miners last week, and they're wavering between their bullishness and so we have to present these different strategies where it's like, well, if you're bullish, we'll come up with the structure where it's like, yeah, buy a put or a put spread, because they don't want to give up upside. And this is like, now this is a Q1 conversation because the market's turned and the bottom is in and FTX was the bottom, and so it's crazy, but that's the mentality that you are always presented with in crypto. It's like this, it's hard to shake this hodl or this speculative kind of mindset. Adam, I don't know if you had other sort of thoughts on this. But
yeah, the only other thought on that is that, it's uncommon to find industries where the business is like really taking putting themselves into a position where they're saying, well, we're going to take a gamble. And so we're presenting solutions to miners right now where we're telling them, you need to choose right now. Like, are you bearish or are you bullish? Because that determines what we do for you. And so there aren't many industries like this. And I think that the upside that miners, can potentially have if they are able to, mine profitably today, you have your HODL strategy. The upside is so big that it's advantageous for them to take a stance. And it's a tough decision for them because clearly they want that upside of Bitcoin going to 6 figures. And so we do the best we can to help them out, but they ultimately have to make some really hard decisions.
Right, that makes sense,
guys. On the downside, like from these sort of miners you speak to, is there like a common kind of break-even price of Bitcoin that when you sort of speak to these guys?
Yeah. Adam, do you want to comment on this? I mean, I have a rough idea, but
I don't know. I don't know if there's like a common price on it. I've seen all over the map, but it typically ranges somewhere between 8,000 to 18,000, per Bitcoin. That's their cost of production for BTC. Yeah, I don't know, Nate, if you had anything else to add to that, but that's commonly what I see.
I mean, we always ask people if they could choose a floor where they want it. I think when we were at 18,000, everybody was like 15. That's the absolute bottom. And now everybody's like 22. That's the absolute bottom. We can't go below 22. It's interesting. The size of the miner correlates closely to the price floor that they need, and the bigger they are, the higher the floor, which really speaks to the cost of capital that they've taken on, right? These guys have debt obligations that what we're seeing now is we're working with newer miners. These guys are picking up machines on the cheap. They're buying these collapsed guys, they're taking in these machines at half price, and they don't have these big debt obligations, or at least it's not coming due. So they're mining at 8, something like that. I mean, they're mining at super cheap prices. And then we were talking about this yesterday, but everybody knows this, but like Bitcoin is the natural solution for finding the cheapest power in the world. So we were talking to guys in Texas, but now we're talking to guys in Paraguay. It's like it just finds the lowest common denominator of power price. And all of a sudden, the guy that was mining for 8 cents is losing out to the guys that are mining for 4. And that's a hard thing. It's an interesting market. The other thing that, we always sort of find out is that these guys are hedging against sort of nuanced power generation models where I had never thought about this, but like in the US, depending on snowpack in Colorado, depends on how much hydro flows, depends on how much power they get. And so they're literally monitoring weather patterns and trying to hedge against the amount of snowfall they're getting. So right now there's a bunch of snowfall in the West Coast, and they're like, oh, it's going to be a great year for power in America because there's been a lot of snow. I mean, and I'm like, I can't believe we're basically trying to hedge the weather here. But that's really how, it's crazy, the way they model this stuff. It's like you're basically buying a call option because there was a whole lot of snow in Colorado this year.
It's unreal.
It's nuts.
That's amazing.
Yeah.
On the energy side, are they looking at hedging out some of the sort of energy price risks as well?
Yeah, I mean, they definitely are, and that's something that they try and monitor pretty closely, depending on how they're getting their power. Adam, you could probably speak to this better than I can, but the sources of power are so diverse that some guys are actively hedging and other guys they get these really consistent flows. Adam, I don't know if you have other sort of insights there.
Yeah, not a whole lot. I'm aware that there are quite a few miners that are hedging, different energy source, futures, so that it plays to their advantage.
Yeah, usually it depends on the construct of the power, like if they're getting coal versus if they're getting renewable is such a inconsistent source that they tend to hedge more because they have to buy that power.
Right.
Yeah, interesting.
Going back to the Bitcoin derivative market, I would kind of elephant in the room, and especially, we're Paradigm, all our volumes are derivate, right? It kind of feels like a big inhibitor of miner deriv volumes is this, inability to access, these more liquid offshore exchanges where the vast majority of the volumes occur. And I mean, given the direction of travel this year, it doesn't look like derivative access in the US is going to get any easier unless you stick with CME. And the CME futures data, through like their commitment of traders reports, do show that miners are becoming more active there. Do you think this is going to continue to be the venue of choice where, okay, so the futures liquidity in CME is building, the options liquidity is not yet there? And we actually talked about this on a previous podcast, but, it's definitely could be the case that once you have the futures liquidity in CME, that's going to trickle into the options liquidity on CME. Do you think that is going to be the venue of choice, or do you think most are just going to choose to remain OTC? Because we know there's a massive flows that are going up OTC as well.
Yeah, great question. That's like the $1 billion, $1 trillion question, right? I would love to think that it's going to move to, OTC and CME. I see what you're seeing, like it's trickling in, but it's certainly not flowing in at the rate that it needs to. And it's certainly not enough to hedge the exposure of US miners. We have conversations with a lot of these guys, there's the ability to set up offshore entities that can trade in, on Deribit. I have my own concerns with the longevity of that type of structure, especially given the fallout with Binance right now and the way that CFTC is sort of cracking down on these offshore entities. I think over the long arc, I have to believe that it's going to, come to these more, say, legitimate venues, and certainly OTC desks are probably reaping the majority of the benefits right now. But I'd like to think that you know, in a matter of say 2 years or 3 years, we're going to see the CME be the main venue for some sort of liquid central limit order book for listed derivatives, because, you know, it's just sort of the necessary exchange for these guys to really operate and to grow and to do it sound and successfully. It's the same thing. It's sort of the analogy we made with oil and gas. It's like oil and gas's ability to grow was based on their ability to hedge, you know, because it creates sustainable financial models that they can depend on year after year. The problem that we all saw last year is that guys that were flush disappeared in months, I mean, days, whatever, you know, and things that happened that never would have thought would be possible. It basically just crushed these guys that they didn't have a plan. I mean, and that's, you know, we're dealing with the fallout of that right now, and it'll sort of splinter the mining markets all over the world. But ideally, we have these sound sort of financial markets that can support mining in the U.S. because, and this is me being, you know, sort of maybe whatever central to pushing for U.S. Normalization for mining, but I want to see that happen. I mean, it's just imperative for sort of the security of the network and things, you know, continuing to grow and that up into the right price trajectory. That's the kind of stuff we want to see.
Cool. David, so on any final thoughts around the hash rate derivative stuff? If not, we can kind of move in briefly to, I think Shanghai merge slated for April 12th. So if you guys don't have any comments, further comments, we can go into that.
No, good. No, I thought it was really interesting, guys, hearing about that. Thank you.
Cool. Okay. So very briefly, I read your February Digital Asset Digest, and I think I read you guys saying that you like being long into the ETH Shanghai upgrade on April 12th. And I think we can all agree that, you know, while this is good in the long term, as the ability to actually withdraw your staked ETH is massively important into growing the ETH staking ecosystem. But in the short term, there are arguments that it could lead to some pressure as well. And there's more and more chatter about this. I'm curious to hear what your thesis is around this.
Sure. I mean, I could tell you my thesis and then the trade structure that we like. And Adam, you may agree or disagree, but I tend to think that what comes out of ETH will be replaced by what goes in. I think that, you know, institutions like us, if we had solutions where we could stake and then use staked collateral to trade, that would be huge. So if you have institutions with thousands or tens of thousands of ETH sitting on the sideline because I can't put it in because there's a liquidity mandate that I have, but now it becomes liquid, I think there's a huge supply that would be able to come into the ecosystem for staked ETH. So yeah, I guess the trade I like would be long Delta, short Vega, which is, I think it's basically a non-event from the vol side. I think it's like a sell the April 14 vol to and maybe be long the back end vol or back end Delta, but that's the structure that I like to trade it.
Right. Interesting.
Adam, I don't know if you have thoughts on just sort of what's going to change when it goes live, but yeah.
No. I'm in line with your thinking on this one.
Yeah, I mean, just even speaking.
What about you guys?
Paradigm, we've seen very little interest in need to get. We've seen a lot of trade pitches on it, kind of floating around in the market of let's get long ETH vol, but there certainly hasn't been a lot of action, and there certainly isn't really even a term structure kink going on. I mean, just look at the ETH BTC spreads, right? How much that is compressed.
Yeah.
The fundamental thesis everybody is following is much more Bitcoin and that digital gold narrative, and all these banks blowing up. I think people are looking at that much more than they are ETH. We have been seeing some ETH upside being bought lately, but this is people covering the short ETH BTC spread. This is risk reducing sort of flow rather than people actually adding risk. But I don't know, it's this is where having a PhD in behavioral finance would pay off, right? You need to have the reality is, so at current spot levels, and so Batuta, these guys do some pretty good research around this stuff. And at current prices, you know, roughly half of the illiquid staked ETH right now, not stuff that was in Lido, is up money, while the other half has lost money. And out of the losers, a large percent of these people were staking at, you know, prices of 2,400 and above. And you could make this argument that people that staked there are going to be more likely to be paper hands and have a higher marginal propensity to sell than somebody who staked at $500 and is in it for the long term, right? You need to have like these assumptions and strong beliefs where like, okay, you need to believe this is the amount of outflows that I think that are going to come as a result of this and selling. And then you also need to have this view of if there's going to be enough inflows to really catch that sustained selling pressure over the long term. For me, I don't have a PhD in behavioral finance, so I don't know. But like, the reality is, at least what we're seeing on Paradigm is like, people really don't care at this point. You know,
I think it's kind of a non-event.
Yeah, right.
Yeah, we've spoke about this before on this show, and like I'm kind of with you guys in that I actually see it as being probably like a more positive event, because all of a sudden it frees up people to actually stake, because they're not losing liquidity in return. And then I'm kind of the view that the risk of sort of selling, I think, would be higher if spot prices were higher. I kind of think if you were willing to sort of lock up your ETH for kind of an unknown amount of time, you probably are a hodler. And
like, you got diamond hands.
Yeah. And like if I think with my own sort of staked ETH, when I was staking that, the consideration I had, or the concern I had, was what if we get some kind of silly move, you know, sort of post merge, where ETH goes on a massive tear, and actually I'm like, shit, I want to sell some of this, like, and lock in some of this money. Obviously we're not there, and so now you go, okay, you kind of leave it. So I think if you're a hodler with a long-term view, and we're probably nowhere near those levels where you would have thought maybe that's the levels I'd start maybe sort of locking some of this P&L in. I kind of feel that you're gonna, the sort of sell pressure is not going to be so huge. And then on the flip side, I think there's going to be sort of more institutional money will start to stake, and certainly offset any selling pressure. The other thing, and so I know Sehan looking to jump in. The other thing that I've sort of been thinking about is, if you were concerned, if you were staking, and obviously, you know, price goes up, then we're all happy. But if you're concerned about the downside, and you've got your sort of ETH locked up, then potentially you're going to be buying sort of puts as your hedge to that. So I actually wonder whether then, like, through the event, you start then to take off those hedges. So you see a lot of selling of puts, and that in itself might actually kind of be a positive sort of driving force behind ETH. But yeah, just I don't know, any thoughts on that, but just
I mean, not just puts. I mean, also just, you know, basis plays, right? You know, selling of longer streams. Yeah, selling the perps or the fixed stated maturity. I think it's a potential catalyst for that basis to continue to go negative.
Yeah, I mean, I think for me, I think this is like a big risk event, right? I mean, one side is right, one side is wrong, or you know, like it could go in either way. I just don't understand how that spread can be that tight, the ETC beats BTC ETH spread, right? Because I mean, if you really look at it, you're paying a 2 vol premium for ETH for a month. I mean, it just doesn't seem like that's the right price, right? Because I mean, everyone is focused on the digital gold you know, angle, but like for that 2 vols, you're buying, you know, the ability to, you know, some disaster happens or some very bullish event happens, like over the merge. I just don't see how that cannot be a good trade. I mean, that's basically the option premium that you're spending, right? 2 vols.
Dude, ETH was trading 2 vols under last week. It was like insanity how cheap this stuff looked.
Yeah.
Yeah.
You know, it's crazy. I mean, it happens in all markets. And like, you know, if you think of options premium as being insurance, you know, and you don't buy insurance when your house is burning down. And we see, like, time and time again, where, you know, nothing happens, and then we'll be like a week away from the event, and then everyone's scrambling to buy that premium. And you're like guys, you know, the time to do it was actually when it's pretty cheap.
Yeah, right.
And there's like throughout my career, there's like countless examples like where I'm speaking to guys saying, you know, we've got this big risk event coming up. Should we not be buying some optionality on this? It's, yeah. And then, you know, a week later, everything's blowing up, and vols are blowing up, and everyone's shit. And this is big scramble then to kind of sort of buy the vol.
But the problem is the puts don't perform, because we've been in this positive spot vol correlation, and dealers are long to the hilt puts, right? They're this long all this put inventory, and then as we go lower, the vols come off. Right. So you can have these moves where like you have a 3 or 4% move lower, then your puts are lower in value. So that's we've been seeing that.
Yeah, I mean, look,
all year.
I think as a vol play, I can definitely see that going, you know, like there could be downside, right, on these trades. But like I think it's not like that spread, right? Like there is a chance that this just blows up to like 50 volts, right? Like that spread just goes 50 volts. Right, so you're paying a 2 vol premium, right? I mean that's kind of the way I'm thinking about it, right? How much can you potentially lose on this, right?
Well, dude, if another bank, if I don't know, another bank goes under, we have all this short gamma to the upside in BTC, right? Like all these, you know, 32 to 35K strikes that have been lifted, and by taker wallets that are massive. And if we start to rally, we'll come back and try to push it higher, right? I could see how it can get a squeeze. Could get pretty nasty in BTC pretty quickly.
I see. So yeah. I guess the worry here is that you get squeezed on this particular strike, right? On this particular strike risk, right?
My point is, I would not sell BTC vol against it. Like, sure, if you believe like, okay, yeah, like you want to be long vol into the event, yeah, you're gonna have to carry that. I would not touch short BTC at the moment, especially the upside stuff.
Yeah, well, I mean, I think your argument actually quite a yeah. I mean, this is clearly why it is where it is.
Yeah.
Right. I mean, I'm not really thinking about strike risk. I'm not thinking about dealer hedging. I'm just saying, like, you know, if I just wanted to hold, if I wanted a cheap trade into the upgrade, right? I mean, to me, this seems like a beautiful trade, you know, to put on. I think you can also construct it in like, because I was thinking about it, like how exactly to play it, right? Like, I mean, I was thinking like maybe like put versus put, and just take like a directional view, like as in you buy the ETH put and then finance it by selling a BTC put. Because then you kind of get out of this whole like, you know, negative gamma thing that you're on the top side, right?
And
so
you
like,
get down.
Yeah, and I like that structure.
Yeah, and look, and you know what's going to happen, right? Like, I mean, really, you know, if you're really buying the hedge, I mean, it's that everyone sells, right? The moment it becomes when you can unstake, and then that's going to be a move to the downside, right? So, I mean, I was thinking that, but yeah, look, I mean, I also recognize that there is some risk here. Maybe it's worth going into the chart, you know, on this.
Cool. Well, we'll price it up after we get off the call.
Yeah, I was gonna say we'll price this one up after we get off this call. I'm like, oh, yeah, we could go short BTC puts, long puts. Yeah, fair to that.
Yeah, it is like trade. Yeah, I like that as well. So it makes a lot of sense. I think as well, it is super interesting, just the lack of conversation or interest from clients around it. And I know, like we say, this Bitcoin gold narrative is just captured everyone's attention. Also, as well, I think the other thing is right now is Bitcoin is just the cleaner play on everything, right? Like, you know, Gensler wanting to label everything as security but Bitcoin. So you kind of got the risk around that. And I just kind of think it's, the focus, it just feels an easier trade right now to be playing sort of Bitcoin vol, I guess. And there's lots of complexities around the different outcomes for ETH, and like, you know, traders generally, without offending any of them, are pretty kind of simple characters, right? And think in terms of risk reward, and it kind of just feels an easier play to be sort of playing about in Bitcoin vol right now. But then often that's where opportunity lies if people's eyes are elsewhere.
Yeah, it's interesting. Bitcoin become like it's got multiple narratives now, where you have the sort of macro narrative with it's the Bitcoin's gold, it's like a downside hedge against fiat, right? But then it's also got you see all these alts that are basically underperforming, flat, they're just not doing anything, which what we're talking about is you're seeing liquidity come out of alts for a number of reasons, but almost like it's like a regulatory hedge, right? Where if you have Coinbase getting a Wells notice, Binance getting sued by the CFTC, and people are speculating whether or not these are going to be like good places to keep their money, Kraken, KuCoin, everybody's like, there's something facing all of these guys. Well, cool, I want to consolidate, and where they go, BTC. And then you sort of put the market structure angle on top of it, where you've got this like short gamma trade, and the whole thing just keeps building like these multiple narratives that it makes it dangerous to try and sell vol. I mean, would you take the other side where you would be long BTC calls, short ETH calls on the flip side of that trade?
Yeah, look, I mean, I always like these kind of like directional vol trades, right? I mean, I just seems always like you can always spin a story on them. But honestly, I thought the ETH downside was the right trade. The upside, I mean, it sounds like this is a very scary position, which everyone's talking about. So yeah, I'm not sure I would do that on the top side either, because
I mean, it's easy to see the top side being capped, sort of like the ETH 2.0 merge was kind of a non-event, or at least all of the delta was into the event, and then after that it was just sort of, it was dead. But I agree, I wouldn't trade the top side.
I'm a little bit scared about selling like that ETH leg, because I always think like these ETH stories, right? I mean, just because we had one ETH event, which like the merge, which was a non-event, right? Like I kind of think people are just like kind of forgotten about these things, and they think it's all going to be irrelevant. I mean, I don't know, one bad story and like something fails, you forget the unstaking, like maybe it's delayed, or like I don't know, I'm just
So Han, you sound traumatized by 2022 still.
I am.
Bad trade.
We have this podcast. I'm just like, oh yeah, 2022. All these stories, like,
what's lurking around the corner now? Yeah.
All right, awesome.
It's now, it's crazy how it's changed now too. It's like these stories, the things that would have just crushed the market 3-4 months ago, it's like BTC is bulletproof now. I'm almost like Binance getting
that was the biggest buy the dip
non-event
opportunity. It was just like, oh my god,
it was amazing.
Yeah, I thought that was going to be a 20% drop for sure, right? Like, and then just gone straight back, right? I mean, it's
I think people are just warming up to the reality. Like, this isn't anything new of the U.S. cracking down on crypto. The center of gravity is just going to move east. Dubai, correct. Hong Kong, Singapore, and either at this point, U.S. doesn't want to play ball, so other people will, and I think other regulatory bodies kind of smell the blood in the water, if you will, right? China sold the highs with the Bitcoin mining, and then now they're buying it. Now they're buying the lows.
They're buying the lows. Great trade on China's part.
Yeah. I mean, it is super interesting though. Like the lack of sensitivity now to these headlines out of the US. I think the market's just kind of numb to it. We sort of move on pretty quickly. I think we're all kind of comfortable with the idea that, okay, fine, if the US doesn't want to play ball, then crypto's gonna probably build outside of the US. And like you say, Joe, we've seen Hong Kong actively engaging with banks around crypto. Certainly in Europe and here in London, you're seeing governments and regulators take quite a consultative approach, and they're quite open in kind of trying to sort of draw up a regulatory framework. So I think there's a lot of positive offsets to what the US are doing, which is interesting. One thing I was watching that I think is going to be really interesting. Obviously, we've seen like Ripple the last couple of days has sort of outperformed And shit, can you imagine if they sort of win that case against the SEC? I mean, that's going to be a real kind of positive development for this space. And it sounds like it's been going pretty well. So
yeah, I mean, yeah, I think there's like binary risk for, regulators right now, that if it's almost like the loss is priced in, but the win is the surprise to the upside. So if Ripple, or I know Coinbase hasn't even gotten started, but from what I've been reading, it's like they've got a pretty good case to fight. But yeah, it's just super interesting. It's like, man, these are catalysts to the upside. I am curious. I mean, as a U.S. citizen, I'm like, I don't want to see everything leave, because then that means I got to go somewhere too, probably. But yeah, it's crazy to think that we would regulate crypto out of the States. But yeah, I mean, who knows? Anything could happen. Like Binance, they had one of their market makers like 12.5% of their daily volumes or something like that. I'm like, you'd think that would be a pretty crippling blow to somebody like Binance, but I'm sure, I guess at this point they can just get that flow from offshore market makers now.
Right. Yeah, and look, I mean, we'll still a bit away, but we'll see what happens in 2024, right? I mean, DeSantis is the leading GOP candidate right now, and he's Adam. You're from Miami, right?
Yeah.
Right, and he's the leading candidate, and he's certainly more pro crypto, right? So these things can also just change administration. I mean,
that's true.
Now Biden and this administration is just playing defense.
Yeah.
But
money talks at the end of the day. Like, what's the saying about politicians? Like they'll get the right answer once they've exhausted everything else, or what have you. Like I think they'll get there in the end, and once they see like other jurisdictions kind of making fortunes in the space, the pressure will come from banks as well, because they'll want to play in it. And yeah, money talks, and I think it's kind of laughable when you've got the SEC that sort of parading on this kind of moral crusade. Like I think once once they see others making money, the sort of green eye envy will be there, and things will change quite quickly.
Yeah.
I mean,
all right, cool.
Anecdotal evidence, like about what this whole consultancy way that Eastern regulators are going, right? So so there's a conference in Hong Kong right now, and the regulator actually reached out to a bunch of banks and crypto players to basically say, how should we regulate to have a digital asset license, right? And it was a literal call out. And it's like a round table where people are like, what would you suggest is your best way to regulate, right? So which is a very, very different approach, right? Which is it's much more like a collaborative way of dealing, which I think is like as David was saying, it's like a real stark contrast to the US. And people literally were like, well, we should put in place something stringent so that we don't have another FTX happening, because I mean that kind of that was, I mean, FTX was for the longest time in Hong Kong, right? So I thought it was a great headline to hear that.
All right, cool. I think this is a good place to end it. It's been about 45 minutes. I think it was a very, very thoughtful and productive conversation. So really appreciate Adam and Nathan hopping on, and maybe we'll do it together soon.